Okay, so where else better to start than chapter one? I do follow the textbook very closely. I think it's a good and great resource to use. What I want to do, and what I think this chapter is going to do best, is kind of synthesize all the material that we're going to be going over in the future, okay, and give us kind of a top-down view of what we're going to look at. So right now we're kind of looking at the forest. Okay. We're going to get an idea of what that forest looks like, and then we're going to look at the trees as we move on. Okay. So we're going to look at all the tools and techniques, but I want to introduce the idea that you may have multiple roles to play when it comes to employee benefits or retirement. You could be the employee, you could be the employer. Some of you could be advisors, fiduciaries. So we're going to look at this from employee, employer, and advisor perspective. And I'm going to do my best to kind of switch those lenses each time that it's applicable, so that we can kind of see all the working parts. Okay. Now, your online assignment, one of them, is to watch this video right here. It's 2 or 3 minutes. It's a sell on the importance of employee benefits. Okay. So keep in mind that's an online assignment there. You don't have to write anything, just watch the video. Okay? All right, so usually when we think of employee benefits, we have this traditional idea that we have set up here. So we couch it as being important because it's retirement plans. That used to be the number one. Now health insurance is kind of taking over when we look at employees and what's important to them. Okay? Retirement, health insurance, and kind of on the periphery sometimes will be things like life insurance and disability. Okay? Vacation days, people like that too. We can also look at PTO, so paid time off, which aren't always combined with vacation days, right? But those are your traditional benefits. And in fact, most of our time in this course, this is where we're going to be spending, with traditional plans. But I think it's important to keep in mind there are new modes through which we can offer compensation to employees that's not just salary. Okay? So child care, legal services, employee assistance. So a couple examples there, individuals with drug or alcohol addictions or struggles. And then wellness programs that tend to be tied to health insurance plans as well. Okay. But again, we'll be spending most of our time with traditional plans. So why do we care? Right? That's one thing when we're sitting here and we're taking time discussing matters. If you're in any class, it's always good to be like, well, why does this matter? What's point A, what's point B? Why should I care about this? Well, first is they comprise a substantial proportion of an employee's overall compensation. Around 30%. Around 30% of total compensation. So if base salary is 50, the total compensation value could be closer to 75. They are also very important from an HR perspective in retaining employees. So what we know, benefits retain employees. Salary gets them hired. That brings them in. But benefits are really what keep people there. I'm not saying salary doesn't keep people in their positions. But benefits tend to be what most people are beholden to. So if we're thinking from a managerial perspective or an HR perspective and want to build up kind of our brand for our employees, the benefits are a good way to go. Okay. They're not an end-all be-all, but they're a good start. There are some government-provided benefits that fit into this, and they are a large expenditure on the federal budget, very large. And depending on how we compare and contrast them, we could say they're the largest, but we'll get to that in a bit. And the tax breaks. So either deferral through 401k, 457, 403b retirement plans, or HSAs are huge, huge. So here we iron out those three perspectives that I want you guys to kind of think of. Okay? If we are that outside observer, so really this would be the advisor, we could think about it, we're the outside observer. We have the employee, we want to think, well, how can I, or they, how can they best utilize these benefits? Is that HSA a good option? Or should I take the health insurance plan? For most, it might be the HSA. But again, it's not a one size fits all. As an employer, how can I maximize my value? Now, I can value maximize through retention. I could value maximize by cutting benefits because it's a cost. But how do I maximize franchise or firm value? Now, from the outside looking in, citizen policymaker, how much does the government have to do with this? And I'm not saying that this would be on the extreme of saying, well, government should provide for all retirement through Social Security. I mean, that's a thought. But it could be as simple as, well, should we change the Roth IRA income limitations? Should we move it up? Should we move it down? Should we allow the same tax breaks for 401ks? That's all something the government chooses. So it could be based on taxes as well, not just what's being directly provided. This is a quick graph to kind of show us that, we hear about wages stagnating, and that is true. Wages are stagnating for the most part, but employee benefits are not. Specifically with respect to the expenses tied to health insurance, that tends to be the largest growing portion, which is also tied directly to how expensive healthcare is. So as healthcare cost goes up, so too does health insurance, because health insurance is just insurance for healthcare related needs. So as healthcare goes up, health insurance, all of things constant, will increase as well. And we kind of see that in the employer spending, employer spending. And I would guess that employee spending on health insurance is probably also going up. So, all right, so they matter. But what are they? What can they do? What do they give the employee? What do they give the employer? If I'm that kind of outsider looking in, why do I care? Okay. If I'm not that employee, I'm not that employer. Why are these things important? We know that, but what can they do? Well, basically, and we'll go through each of these, help employees meet certain financial needs that they might not otherwise be privy to. And then provide unique tax benefits that they're absolutely not privy to, okay, with few exceptions. So what are the needs? Pretty simple. We won't dive into the weeds here. Health insurance. And we'll talk about why we see some group insurance benefits that we couldn't get otherwise. Retirement savings. Unfortunately, most people do not save enough for retirement. Nowhere near it. And then family protection. So this would be like disability insurance for you or life insurance for you, you being the employee in this case. Now, the tax benefits, certain qualified plans allow me to defer paying taxes, me as the employee. And 401k plans, most common example, HSAs can do this as well. There are different types of 4 series retirement accounts that we'll discuss. But for the most part, the tax deferral works in very much the same way. It comes out of my paycheck. If I put $1,000 into my 401k, I'm not taxed on that $1,000 until after retirement and I withdraw that money. I'm taxed on it at that point. So it allows me to defer the taxes I paid on that. While the funds are sitting in there, they gain interest. I'm not taxed on that interest. So it's tax-free interest gains. HSAs would kind of follow that. We'll discuss a unique kind of what's called triple tax advantage, and it's not a misnomer. A triple tax advantage that we see with HSAs. Now, so what a number of retirement plans do, they do increase the benefits available at retirement compared to just saving. Because if I were just to put all that money, $1,000 or so, maybe bump it up to $50,000. If I were to put that money into a savings account, if it were to garner the same amount of interest that the funds that I'm investing in my 401k are, I would be taxed on that year. So I don't get to defer, so I'm taxed each year. So if it's $1,000 and at the end of the year it's $1,500, that's a crazy amount, but let's say that's the case. I'm taxed the appropriate capital gains tax on that $500. If instead it's in a 401k, I put 1,000 in, say it also is up to 500. These are very good numbers, by the way, impossible almost. But let's just, for the sake of argument, say that 500 is what I gained in my 401k. That next year, I still start out with 1,500, which garners more interest. And interest on $1,500 is going to be more than the same amount of appropriate interest on something less than $1,500. So it keeps compounding too, and you're not taxed on it again until after the fact. Okay? HSAs also work this way. Now, with these tax benefits, I'll make a quick note here on HSAs. Oftentimes, and some of you may have heard this, the HSAs are triple tax advantage. Now, if you really dive into the details, you could argue, okay, that's not entirely true. But I think right now, at the surface level they're looking at, it is. So the 3 tax advantages, first, it's pre-tax. It comes out of your salary. It's not taxed then and there, so that's the first advantage. You defer it. If it's in an interest-bearing account, which most are, that interest is not taxed. And then if you use it for qualified medical expenses, it's tax-free. So if you have, $5,000 in medical expenses, which is fairly easy to do, and you have $5,000 in your HSA, and you pay for those expenses, that $5,000 was never taxed. You were never taxed for that $5,000. So if your appropriate tax rate is, let's say, 25%, so that means that 5,000 would have been about, or let's say it's 20%, that 5,000 would have been 4,000. And you would have to come up with another $1,000 after tax to pay for it. But instead, you didn't have to do that. So essentially, it saved you $1,000. So that's kind of where the triple tax advantage comes from. Okay. And again, you could really, really kind of dive into the details and say, well, actually, but we won't worry about that for right now. Okay. HSAs are usually a pretty good deal. They're not a, one-size-fits-all though. Now, what about the benefits of a group insurance plan? So how can an employer also kind of get in on some of this? All right, we can defer some of these are expenses, so on and so forth. But what we can really focus with the inherent advantages here, these first two are imperative, okay, and very important for lowering the cost of a pool of insured. So this first one here, we have pooling advantages. So in your intro to risk management insurance, I'm sure you talked about pooling advantages. You pool all these risks together. It makes it a little bit easier for you to estimate how much you're going to lose, what the deviation may be about that loss. So you can mitigate risk. Versus if you just have one person. You just want to insure one person. Okay, that is not ideal. Insure a couple of thousand, that's a little bit better. So you have these distinct pooling advantages. On top of that, we see reduced adverse selection. So adverse selection, as we describe it here, is an individual opting in to a health insurance contract because they need health insurance. Okay, so they might be high risk and they're seeking insurance at an average risk premium or rate. So how do we reduce adverse selection? Does anyone, how is group insurance reducing adverse selection? So I'm getting it through my employer. Am I selecting that employer specifically to get health insurance? Probably not. Maybe, but probably not. So what happens is we have this large swath of individuals that are coming together mostly just to get paid, to get a job. So it's a large, pooling, so we have pooling effects. They're not coming together just to get health insurance. That's not a bad market to insure. Okay. Compare that to maybe the average pool of individuals going on the health insurance exchanges, okay, during open or special enrollment periods, there would probably be significantly higher adverse selection in those markets. Okay. So we have pooling advantages already from the get-go. The insurance company doesn't have to do anything to pool. I mean, they do, but they don't have to. There's reduced adverse selection because they're getting health insurance because they have a job, not because they need health insurance. Again, it could be that you get the job for health insurance, but it's not for everybody. That leads to reduced expense loading. We also, to help the employees, we don't need evidence of insurability. So the pool's pretty big. It's fine. Come on in. Hop in. The water's fine. And there's usually an ease and convenience of shopping within these plans offered. And then an ease of payroll deduction. So you don't have to say, oh, did I pay my health insurance premium? It comes out of your payroll. It comes out of your check. So these are some things to kind of keep in mind. Now, some disadvantages. Okay, disadvantages. And I'm going to add one here. And let's go ahead and start with that addition. So the first thing is, if you could somehow pick, as the advisor or the employer, if you could pick the best plan for all your employees on average, even if you could do that, say here's the best health insurance plan, it's an HSA paired with this high deductible plan, it's better 99% of the time. Even if that's true, you run the gamut of it being wrong for that 1% and then hating you for it. Because like, we only gave us this one plan. So what we notice is that people are happy to have bad benefits or health insurance as long as they have an option to choose those bad benefits. So if we give them, there are studies done where we'll say, this is obviously from an actuarial standpoint a worse plan. It costs the employee just the same, but because maybe it has a lower deductible or covers a few other little things in just a slightly different way, they'll opt for that plan, even if it still costs them more. Okay. So maybe the deductible is lower, but the co-insurance is higher after the deductible. So unfortunately, that's one disadvantage, is you kind of have to, even if you know if there's a good option, you can't tell your employees what they should be doing, unfortunately. Because it's a risk management technique for the employer. You need to be careful, because that 1% could be costly. The other disadvantages that are listed here, they are difficult to reduce. As I said earlier, the benefits are what retain. You start dropping those, retention is hit. It's very costly to hire a new employee. You generally have to go through the hiring process, and you often have to pay them more as well. So it's generally more difficult. If there are differences across the plans, there could be some resentment, unless you're clear about what constitutes the difference. So Ball State faculty and staff have different benefits. Different benefits. Does increase labor costs. Takes time to iron out all these details. And the tax treatment can encourage overconsumption. We'll discuss that, a little more detail later. Now that we know these pros and cons, how do we, if we're kind of an advisor, how do we help an employer and employee identify what is best for them? Okay, so I already know that just giving one health insurance plan is probably not the best way to go. Okay, but what are some other details? Well, we've got to know about the client. We need to know the employer. We're going to have this fact find with the employer in which we can gather some data, use that data to make decisions and support our decisions. Alter a plan if they have one, or create a new one. Tell them about that plan, and then make sure that they are monitoring that plan. So this periodic review is in any risk management process. Okay. Risks are dynamic, they are not static. So if you just let something sit, any risk management plan, because this is risk management, if you just let it sit, eventually a good plan will turn into a bad plan. Okay. So let's go through each of these steps. With the meet and greet, I would call it. Okay. Keep in mind, there's no one right option. Rarely is there one right option. I guess I can't say there's never one because that's an absolute. I don't usually like to use absolutes. Your employer needs can vary drastically. Drastically. So when we meet, we again have this, as I mentioned before, fact find. So this is the gather data portion. So the fact find, gather data meeting all kind of coalesce into one, kind of step of the process, as I see it. Now, we can collect in a number of ways. It's not a bad idea to ask the employees how they feel. It could be that the employees love the benefits they get. It's pretty good plans, and it's not costing the employer too much. In that case, you as the advisor, give them a thumbs up, send them your bill for your time, and move on and help other people. Okay? You've identified that they have a good program set in place. If the employees like it, it could be better. Now, if we see some room for improvement, we can move on to company financials and compare and contrast maybe other players in that industry. So other firms in that industry. Say, well, if you want to be competitive, or we have one firm offering this, and it's the same as what you have here, but we notice it saves them some money, and the employees are getting the same thing, then that might be a better avenue. Okay. Now, one very important note for all of you, if you go into an advisory role, you need to keep records of all of this decision making. Okay? You need to keep records of this, because if it comes back on you, and especially if you're fiduciary, you're legally bound to make the best decision for your client. If it comes back on you, you need to be able to support why you did what you did. Okay, so keep that in the back of your head. Okay, so document that due diligence. Now, once we've done this, and let's say we want to move forward, the client, the employer, is saying, all right, well, we want to improve some things. You think we can improve it. How do we do it? We say, you need to ask them, what do you want to do? Okay? Do you want to work on that retention? Do you want to work on new hiring? Okay. Are your goals way too lofty? That is sometimes the case. Okay? So let's bring them back to reality while still giving them a product that's useful to them. Some plan objectives may include, we're not getting enough for health care, or we don't know about this retirement match here. We don't mind doing it. It's costing us a little more. Is there another avenue available to us? Should we offer a Roth instead of a traditional? Should we do both? Another big one from the HR perspective are the 4 R's. Recruiting, bringing in new folks. Retaining, that's a big one for benefits. Rewarding, I think of it as incentivizing, but we'll keep the R's. Rewarding, and then retiring. Okay, we won't do all of this. We don't want people staying until they die, because as you age, you get prohibitively more expensive, unfortunately. Okay, that's just what happens. You command a higher salary, but you tend to be unable to provide what you could when you were young. Okay, so retiring is important as well. If you have a good retirement benefit plan, then you might not have issues with that. We want to compete, and we make sure that certain employees are being compensated the way we think they should. Now, you also have to keep in mind, you don't want there to be issues between, like if you have full-time versus part-time, or for university here, faculty versus staff. You want to make sure that it's not creating some type of schism between all your workers. You don't want there to be any friction, ideally. Fortunately enough, for whatever reason, most people don't talk about compensation, salary. Though with government jobs, that's all public. Now, it could be that we just make some tweaks to the plan they already have. That's easy. Still need to document, but we could just tweak it a little bit. It's like, okay, well, your employee benefit match here, your 401k match, it's at 2%. Your industry average is around 4%. So if you want to keep, you should probably bump it up a bit if you can. But we also see that what you're putting into the HSA is significantly higher. So you could maybe increase one and drop the other. There's a cost benefit analysis to do there. But those are just some options. Okay. Now, a simple checklist of questions is usually good enough to get started. what do they want to do? What is the current plan doing? Where would you like to tweak it? Do you just care about one facet of it, or is it a complete rework of everything that you have? So checklists are always good. Another thing you can keep for your records. So here's some examples. This isn't the end-all, be-all. It's not an exhaustive list. You shouldn't just go in and ask these questions and throw your hands up. I'm good. I'm done. Did everything I was supposed to. But just some examples. So what do you have covered? Okay. Are we excluding certain workers from this? If so, why? What do we provide? Are we telling our employees about the benefits offered? That's usually a big problem. That's usually a big problem, is not clearly stating the benefits that are provided, because they are pretty detailed. So that's often a problem. So it could be that the employees are unsatisfied, even though they have really good benefits. It's just the translation from HR, from the firm, to employees about what they have is not as clear-cut as it should be. Okay? So it could be as simple as that. Okay? Now, so if we have this new plan, we need to be able to communicate it. So one problem that I've seen is this kind of idea that a minor seal can keep a ship from sinking, but it might not get it to harbor. Okay? It might not get it to harbor. So Band-Aids serve a purpose, okay? But sometimes you need a tourniquet. So keep that in mind. It could be that just little tweaks are great, but get them home. Get them where they want to go for their employees. And you need to be able to communicate that, and that goes back to keeping all your records as well. Okay? So the thing is, some of this is a bit subjective, so there's some soft skills, and then some of the goals they want could be subjective too. Saying we want to improve employee morale. Okay? It's like, all right, well, enough with the corporate speak. What does that really mean? They're unsatisfied. Ask them why. Here's a questionnaire I want you to ask your employees. I'm here for the benefits. Ask them about this and see why they are upset. If it comes back that they're upset because they work too many hours, or it comes back because they just don't like their work environment, benefits plan not going to change that. So we don't want to spin wheels either. Okay? And if the client still wants you to work with them, then continue working with them. Make sure you do a good job. But do some due diligence and say, this isn't the problem. So it could be poor risk management or management in general. That being said, no matter how perfect, it won't ever be perfect, but how great that plan is, if you don't do a good job as the advisor, or if HR doesn't do a good job getting that information to the employees, then it might as well not exist, or it might as well just not matter. Okay. I've worked for some institutions where, thankfully to my background, I could figure out the kind of the basics of the retirement plans offered, or the HSA versus FSA, because I kind of already know that, right? But to someone who does not have a PhD in finance or risk management, or who's not a fiduciary or CFA, some of these waters can be a bit muddy. But all it takes to clear those waters is a clean, open communication from HR to your employees. Okay, so be sure to make sure the communication is kind of at the top of the list, especially after you have the plan in place. And again, the best part, or the most important part of any good risk management process, is that kind of periodic review. Okay? Quarterly might be a bit much. Yearly is a decent idea. Okay? If you're waiting 3 to 5 years, that's long term in the business world. Okay? You're thinking long term. If you're waiting 3 to 5 years to update, you might be a little behind the curve on that. Okay? So this is something that's important to assess fairly regularly. Fairly regularly. Mostly due to these laws changing quite a bit. Okay? Simple things like, for the last 10 years, the contribution limits on 401ks, 403s, 457s have all increased. Okay? The Roth IRA income limitation has continuously increased. So that's an individual account. Employers would not be dealing with that. But it's still retirement. Okay? So these things are constantly changing. They changed this year. And then finally, the last point of today that we'll dive into after this class is the IRS Circular 230. This, and for all intents and purposes, just to make sure that we're not using this as some kind of way to completely avoid tax. There's nothing wrong with reducing your tax burden. That is completely legal. In fact, as an employee, if you're using the 401k offer, and that's not a wrong, you're deferring taxes. There's nothing wrong with that. But we want to make sure this isn't a tax avoidance scheme for a firm.